Next, we're going to discuss withdrawing a partner from the business. There are two ways to withdraw a partner. The first way we have already discussed. This is when a new partner comes in to replace the withdrawing partner. The second way is when the partnership distributes cash or assets to the partner that's withdrawn. Basically, the partnership is buying them out, giving them back cash or assets to help replace their capital, and removing them from the books. There are three steps involved for removing the partner in this second way. First step is to remove the withdrawing partner's full capital by doing a debit. Remember, capital accounts are credit, CC, C for capital, C for credit. So if we're removing them from our books, we want to do a debit for the full amount, regardless of what we're actually giving them. The second step is to pay out the assets. Usually it's going to be cash, but you can give them property instead, but we're really just going to deal with cash. Since the partnership is spending the cash, cash will get a credit. Remember, it might not be the full amount of the capital. Maybe we're paying them extra to leave, or we're paying them less than their capital. The third step would be if there is a difference, that would be split among the current partner's capital accounts based on the income ratios. So if we're giving them less money than what their capital account is, that extra money that they're not getting, that basically they're losing, will go to the old partners kind of as a bonus. If we had given them extra money to leave, which usually isn't the case, the capital accounts of the old partners will be debited. It'll be removed from them. But that's usually not what we're going to see. So we're kind of going to follow this example here where the partner that's leaving gets the debit and the partners that are staying on will get a credit showing that their accounts are increasing by that extra amount that the old partner is losing. We'll do an example to illustrate this. This is the next one on your classwork, the last one you have, number 5. We have Griffin, Quagmire, and Swanson, who have been partners, and they share their income in a 5-3-2 ratio. What this means is that when you add it all up, 5-3-2, it equals 10. Griffin gets 5 out of 10, so half. Quagmire gets 3 out of 10, 30%. And Swanson gets 2 out of 10, 20%. It's just a different way of explaining this. So in this scenario, Swanson retires from the partnership. This partner, Swanson here, he is leaving. The current equities are Griffin has $150,000 invested in the partnership. That's his capital account. Quagmire has $90,000 and Swanson has $60,000. Assume Swanson is paid $30,000 for his equity using partnership cash. If you think about it, Swanson's capital is worth $60,000, but he's only going to get $30,000 for that. He's losing basically $30,000. To do this journal entry, we'll follow the steps I just laid out. First, we get rid of Swanson's capital account by doing a debit to his capital account in the full amount that he has. He has a $60,000 account. He is no longer a partner. We want to get rid of that whole thing in order to remove him from our books. How much cash are we giving him? We are giving him $30,000 cash. As you can see, my debits and credits don't equal. They are off by $30,000 because he is basically losing $30,000. That extra money is going to go to the old partners. We have Griffin and Quagmire as the old partners that will be getting this extra bonus. The difference between the two is $30,000. That's how much bonus that the old partners are getting. That's how much Swanson is losing by leaving this partnership. We just have to figure out of that $30,000, how much does Griffin get and how much does Quagmire get? With Swanson gone, his part of the ratio is removed. We're only left with Griffin gets 5 and Quagmire gets 3. It's a 5-3 ratio. Griffin gets 5, Quagmire gets 3. How you do this is you total it up, which equals 8. So basically, Griffin gets 5 out of 8, which is 62.5% if you do 5 divided by 8. You do the same thing with quagmire. 3 out of 8, which would be 37.5%. We'll take both of those percentages and multiply it by that $30,000 extra money that Swanson is losing and that the old partners are getting. 62.5% times 30,000 equals 18,750. Do the same thing for quagmire. 37.5% times 30,000 equals $11,250. That's how you do this problem.